What if I told you that you could become your own bank? No permission, no credit score, no gatekeepers, just code. And that code manages billions of dollars every single day. Welcome to DeFi, decentralized finance, but this is not another basic explanation. Today, we are breaking down the strategy behind DeFi, how smart players actually use it, how money really moves inside these systems, and why some people multiply their wealth while others get completely wiped out. If you want to understand where money is going next, stay until the end. Because once you see the mechanics, you cannot unsee them. And if you value deep financial breakdowns like this, like the video, subscribe, and turn on notifications. I post high-level insights you will not hear in mainstream media. DeFi runs primarily on Ethereum. Think of Ethereum as a global financial operating system that never closes. Instead of a bank employee approving a transaction, you have smart contracts. Self-executing code, no emotion, no bias, no favoritism. Just rules written into software. In traditional finance, banks hold your money, banks lend your money, banks earn interest from your money, and you receive almost nothing in return. DeFi flips that structure. You become the lender, you become the liquidity provider, you earn the yield. But here is where it gets interesting. DeFi is not just about earning interest, it is about strategy. It is about understanding incentives, risk layers, and capital efficiency. There are 5 main strategic layers inside DeFi: yield generation, liquidity provision, borrowing against assets, leveraging, governance power. Let us start with yield generation. Imagine depositing $10,000 into a lending protocol like Aave. Instead of sitting idle in a bank account, that capital becomes productive. Other users borrow it. They pay interest. You earn a portion of that interest. But smart participants do not simply deposit and forget. They compare annual percentage yields across platforms. They track liquidity depth to make sure markets can handle volatility. They monitor token incentives that boost returns temporarily. They rotate capital when yields compress. It is not passive income. It is active capital management. Now consider liquidity pools. On platforms like Uniswap, there is no centralized order book like you would see on Coinbase. Instead, trades happen against pools of tokens provided by users. You might deposit ETH and USDC into a pool. Every time someone swaps between those tokens, you earn a fraction of the trading fee. This sounds simple, but there's a hidden variable called impermanent loss. If ETH surges in price compared to USDC, your pooled position can underperform simply holding ETH. That is the trade-off. So strategy becomes critical. Some pair stablecoins to reduce volatility. Others choose volatile pairs for higher fees. Advanced players analyze volume to liquidity ratios to determine whether a pool is worth entering. They calculate risk before committing capital. Then there's borrowing without selling. This is one of the most powerful tools in DeFi. Imagine holding $50,000 worth of ETH. You believe in its long-term appreciation. Instead of selling and potentially triggering taxes, you deposit that ETH as collateral into a lending protocol. You borrow stablecoins against it. Now you have liquidity without giving up exposure. This is how sophisticated crypto investors operate. They keep their core asset while unlocking capital. But this comes with liquidation risk. If the value of ETH drops too far, the protocol automatically sells your collateral to repay the loan. No phone call, no negotiation. Code executes instantly. This is why risk management is everything. Smart players never borrow to the maximum limit. They leave buffers. They monitor collateral ratios. They prepare for volatility. Now we move into advanced strategy. The real complexity begins when people stack these tools together. Deposit ETH, borrow stablecoins, provide liquidity with those stablecoins, earn trading fees, stake the reward tokens, compound everything back into the system. Layered yield can create powerful returns, but each layer adds risk: market risk, smart contract risk, liquidity risk, incentive risk. If one layer fails, the entire structure can collapse. Many people learned this the hard way during market downturns. This is where psychology becomes as important as mathematics. DeFi is 50% math and 50% emotional control. Beginners chase 4-digit annual yields without asking how they are generated. They jump into new protocols without reading audits. They follow influencers instead of analyzing token emissions and sustainability. Smart players move differently. They wait. They study smart contract audits. They track total value unlocked to gauge confidence. They analyze how rewards are funded. If yield depends on constant token printing with no real demand, it is fragile. If yield comes from real borrowing activity or trading volume, it is stronger. History has already shown what happens when incentives are misaligned. Algorithmic stablecoin systems promised stability through complex token mechanics. For a time, yields looked attractive. Capital flooded in. But when confidence broke, liquidity disappeared. Billions evaporated. The lesson was simple. Unsustainable incentives eventually collapse. Now think about why traditional financial institutions pay attention to DeFi. Transactions settle in minutes. Systems operate 24 hours a day. Access is global. There are no borders, no opening hours. The infrastructure works. Code does not sleep. Institutions experiment quietly because they recognize efficiency. Tokenized assets, on-chain treasury management, decentralized derivatives. These are not memes. They are financial infrastructure evolving in real time. The future phase of DeFi will likely be less noisy than the hype cycle of 2021. It will be quieter, more compliant, more integrated with real-world assets. The most transformative technologies often feel boring once they mature. Think about the early internet. Speculation dominated headlines, but eventually infrastructure won. Here is an important question. If you had $100,000 right now, would you trust a traditional bank more or open source code running transparently on a blockchain? There is no easy answer. That tension is exactly where this transformation lives. But we also need to be realistic about risk. Smart contract exploits happen, rug pulls exist, liquidations can occur during extreme volatility, regulatory frameworks are still evolving, stablecoins can fail if reserves or mechanisms are flawed. Strategy is not about chasing the highest number on a screen. It is about risk-adjusted returns. The most consistent participants in DeFi think in probabilities. They diversify across protocols. They avoid overleverage. They understand that preservation of capital is more important than explosive short-term gains. They treat DeFi like a laboratory for financial engineering, not a casino. Another layer to understand is governance. Many DeFi protocols issue governance tokens. Holding these tokens allows participants to vote on changes such as fee structures, collateral requirements, or incentive models. Governance power can shape the direction of an entire ecosystem. For long-term participants, this is not just yield, it is influence over infrastructure. Capital efficiency is another strategic dimension. In traditional finance, assets often sit idle. In DeFi, capital can be deployed across multiple layers simultaneously. A single asset can secure a loan, generate fees, and participate in governance. But again, higher efficiency can mean higher systemic risk if correlations increase during market stress. You also need to understand liquidity cycles. During bull markets, liquidity expands. Risk tolerance rises. Yields compress because capital floods in. During bear markets, liquidity contracts. Fear increases. Incentives must rise to attract capital. Recognizing where we are in the cycle can dramatically impact strategy. Timing matters. Position sizing matters. Emotional discipline matters. DeFi is not magic. It is programmable finance. It replaces human intermediaries with transparent logic. Used correctly, it can increase access, efficiency, and opportunity. Used recklessly, it can amplify losses just as quickly. The core strategy behind DeFi is simple but not easy. Understand incentives. Follow the flow of capital. Measure risk before chasing return. Keep leverage controlled. Think long-term. Control your emotions when volatility spikes. Money is becoming programmable. Financial contracts are becoming automated. And the individuals who understand how to navigate these systems early gain asymmetric advantages. The opportunity is not in blind speculation. It is in education, patience, and strategic execution. If this shifted how you see decentralized finance, like the video, subscribe for deeper breakdowns. Share this with someone who believes banks are untouchable. And explore the resources in the description for more advanced discussions on financial systems. This transformation is still in its early chapters. The infrastructure is being built in real time. The question is not whether finance will evolve. The question is whether you will understand the strategy behind it before the majority does.